Hey guys, welcome back. In this particular video, we are going to continue with bonds. So, in our previous video, we generally talk about what is bonds and what are the key terms which are generally associated with bonds. Okay, so hope those particular terms are clear to all of you. Now, we will talk about the different type of bonds which are available in the market for the investment. Okay, so here in this particular video we are going to talk about the different type of bonds, like we have zero coupon bond. Okay, so what are zero coupon bonds? Then the perpetual bonds, inflation linked bonds, subordinated bonds, and optionability in bonds like callable bonds and putable bonds. So these are the topics which are generally which we are going to cover in this particular video. Before this, I hope you watched the previous one. Okay, so because that is very important one to understand this particular video. Okay, so whenever we talk about bonds, these are long term maturity debt instruments, which means their maturity is more than 1 year up to 30 years. And the debtor or the borrower, they can raise funds by issuing these particular securities for a longer period. Okay, and they offer a fixed rate of interest on these from these particular securities. Now, if you talk about the terminologies which we already covered in our previous video, so we have like coupon rate, okay, which is, you can say, interest rate on that particular bond, redemption value when you redeem that particular bond, or the value at the time of maturity of that particular bond, so that is redemption. Face value, which is stated on the face of that particular bond. Place value, the kind of lot size, the number of investment made by investor in any specific bond. Day count convention, which is related to the interest rate calculation of bond as well. Apart from these, we discuss so many other terminologies as well. So please do watch that particular video. So that is definitely going to help you to understand the concept of bond. So if you talk about the types of bonds, so we have number of we have different types of bonds. So they are generally classified on the basis of the issuer of that particular bond or some specific feature. Like if a bond is issued by a corporate house, that is generally known as corporate bonds. If a bond is generally issued by Government of India, that is generally known as sovereign bonds, like sovereign gold bonds, the other instruments. If it is issued by a corporate house, sorry, a municipal party, so it is generally known as municipal bonds. I hope you guys heard about the electoral bonds, which is generally for election, for the purpose of elections, parties, and all. Okay, or even sometime you'll heard about the tax-free bonds and others like infra bonds, green bonds. So they are generally part. We have different types of bonds which are generally available for the available in the market for the investment. Okay, so here we will discuss few important bonds which are quite important for the examination purpose. And being a student, you need to know about these particular bonds. So before moving those particular one, we have fixed rate of interest bond. So where the coupon rate is fixed, floating is, that is variable. Zero coupon, we'll discuss this one in detail. We will discuss inflation linked bond in detail, perpetual in detail, subordinated in detail. Corporate bonds, these are generally issued by the corporate houses. Okay, like let's say if Reliance issues some bond to fulfill some long-term debt requirements. So that is generally known as your corporate bonds. Tax-free bonds, these are issued by Government of India or state government. So basically, let's say if Government of India is coming with some infrastructure project, so to finance those particular project, they need money. Okay, so they come with some tax-free bonds. So invest that generally attract to investors. So investors, they generally made that their investment in these kind of securities, and they get exempt from the principal as well as interest. Okay, so we have public sector bonds issued by public sector organizations, municipal, local, state government, and central government. So like you can see, if you go through these particular types of bonds, so these are generally like on the basis of the feature of that particular bond. Like if you talk about the green bond, so they are generally something related to where we are generally supporting, our government is fine using that particular money for the greenery related projects. Okay, if you talk about masala bond, so that generally support that is generally called rupee dominated bond. So we are generally supporting these bonds are generally issued in different countries, in other countries, okay, in foreign countries, and the investor, they are generally making money in Indian rupee, okay. So that generally providing strength to Indian rupee or Indian currency, which is INR. So or so basically the categorization is generally based on the issuer type or the main feature of that particular bond. So first we have inflation linked bond. This is very important one. So to understand this one, I hope you guys remember the concept of real income. So whenever we talk about real income, so the formula of real income is, hope you remember this one, that is interest minus inflation, okay. So how this concept work? So let's say you invested 100 rupees in any security. The rate of interest offered by that particular one was 7%. So after 1 year your money grows to 107 rupees. So this is your nominal income. This 107 will be known as nominal income. So you invested 100 rupees at the rate of 7%, and you get, after 1 year you get 107 rupees. So that 107 is generally known as nominal income, because like this is income which is like you do not make any adjustment for inflation and other factors, okay. So if during the same period, let's say this investment was for the financial year 22-23. So during this particular year, suppose that the average inflation rate was 5%. Suppose that during the same period or financial year 22-23, the inflation grows by 5%. So if inflation goes up by 5%, which means the value of our domestic currency will also decrease by 5%, right? So your real income, if you will calculate real income, so interest is 7% and inflation is 5%. Your real income is only 2 rupees in from this particular investment. 100 rupees was your principal, so your nominal income, if you talk about nominal income, it was 7 rupees. But if you talk about the real income, it is only 2 rupees, because during that particular period inflation grow by 5%, so you have to adjust that particular one. Now this was the concept of inflation, okay. So if you relate this, okay, I'll erase this part, okay. Now so guys, now if you talk about the concept of inflation, okay, inflation linked bond. So let's say you invested, or any investor who invested 10 lakh rupees in some bonds, and the rate of interest offered on this particular bond was 8%, and the bond was for 10 years, the maturity period was 10 years. And if you see the average inflation which was for this 10 year was supposed at 10%, okay. So the average inflation was 10% during these 10 years or in last 10 years, okay. So now you can see 8% minus 10%, so your investment goes in negative. You did not make any profit from this particular investment. So to protect the investors from inflation, so government of India, they came with one kind of bond. They basically introduced these one in 2012-13, because that time the inflation was on peak. It is around 10.93%. Okay, an investor faced this particular issue. So to deal with this particular problem, they came with one bond that is called inflation linked bond. Now they, how they generally issue, they mention like whatever the inflation, okay. So it is the rate of interest is inflation plus 2.5% or 1.5% or 1.75%. Now whatever the inflation is, like let's say inflation was during last 10 year inflation was 15%, so no worry, 15 plus 2.5%, this will be your return. If inflation was suppose that 2%, then your earning will be 2.25 plus 2%, 4.50%. So here, by using this particular tool, they are generally protecting the investors money from inflation. So inflation index bonds are securities designed to help protect investors from inflations. Inflation linked bond are indexed to inflation, okay. So as inflation price will goes up, so the value, like which is like the rate of interest is inflation plus this, and they are using that index. So that is the calculation, or even they are this way they are generally protecting the interest of investors. Hope this is clear to all of you. Next one, and very important concept, guys. So many times you need to know about the real income and the nominal income differences, and how inflation basically how inflation is important for these kind of real income calculations. So you need to know about this. Next one, perpetual bonds. Perpetual bonds are like, these are kind of shares. So these bonds, they do not have any kind of maturity. Okay, so they generally work till the maturity of that the time that a company basically exists in the market. Okay, so perpetual bonds, which is known as perpetual or just prep, is a bond with no maturity date. Okay, so it can be like, if a company, we started a company raised fund, let's say Reliance raised fund. So suppose that Reliance work for 500 years, so the maturity of this particular bond is 500 years. Let's say any XYZ company, you invested in that perpetual bonds, they came with perpetual bond, and that company wind up after 4 years. So 4 years is the maturity for that particular bond. So there it is treated as equity, not as debt. So that's why the perpetual bond are generally treated as equity. Okay, so I hope this is clear. Next one, zero coupon bond. So coupon, I hope you remember this particular term. Coupon rate is rate of interest. So zero coupon bond is usually what happen. So let's say if you invested in some bond, so the rate of interest is mentioned on the face of that particular bond. But in some cases, in case of zero coupon bond, you will see, if they'll mention, if you invest 90 rupees in this particular bond, so the current face value is 90 rupees, or your invest value is 90 rupees. So after 1 year you will get 100 rupees. They are giving you rate of interest. Okay, they are giving you 10 rupees per unit for a specific period, but they do not mention that rate of interest or that coupon rate on the face of that particular bond. So these type of bond generally known as zero coupon bond. So a zero coupon bond is a bond in which the face value is repaid at the time of maturity. So let's say the maturity was 1 year in this particular case, or let's say they ask you, you invest 75 rupees and the maturity is 10 years. So after 10 years you will get 100 rupees. So this is the outcome, or this is the return from that particular bond. So here in these kind of bonds, they do not mention the coupon rate. It does not make a periodic interest payment. Okay, or so have called coupons, hence they are generally known as zero coupon. So like in other cases, in some cases you'll get annual returns, but here that things are already mentioned. You invest 75, will pay you after 10 years 100 rupees. So these kind of bond, they are generally known as zero coupon bond. Next one, guys, subordinated bonds, or it is also known as subordinated debt. So if you study company account 1 or 2, so you'll find there are a number of companies who generally raise funds in the form of subordinated debt. So this is like, this kind of debt is riskier in nature. Okay, so let's say if any company is issuing these kind of bonds, so they have a very goodwill, very strong goodwill in the market. Okay, so these are kind of bonds. Okay, but if you talk about the liquidation period or liquidation time, so when we give priority, so they have least priority. Okay, so first we give priority to salaries of employees or the other debt which is raised by that particular company, then we'll return the money of subordinated debt. Okay, so a subordinated bond is a bond which in case of debtors bankruptcy is paid after the payment of higher priority bonds, so-called senior subordinated bonds. Okay, hope this is clear. They are unsecured in nature, and they are higher, like they are riskier in nature, and which means the rate of interest which generally interest get from these kind of bonds, which is higher as compared to other bonds. Okay, next one, optionability of bond. I hope you guys remember the call option and put option. Okay, so similarly here as well, so you have in bond, in case of bond as well, so callable, which is something related to the debtors, okay, who generally, or the borrowers who generally borrow money by using bonds. Putable, which is generally which is something related to the buyers. Okay, so in case of callable bonds, let's say a maturity period of any bond is 10 years. The maturity period is 10 years. So if it is callable bond, so the issuer have right, they can call these particular bond prior maturity. They can pay out customers or the investors within 10 years. They can make payout in 8 years, 5 years, or any other time duration. In case of putable bonds, this is just opposite. So here the right belongs to the investors. So let's say the maturity is 10 years. If this buyer who want to liquid his money, so he can liquid after 3 years, after 4 years, or 7 years, or any time before the maturity. So callable and putable, these are the bonds type. Okay, again very important one for examination purpose. So a callable bond is a type of bond that allow the issuer of the bond to retain issuer. Do remember this, right? Huh? Issuer, please do remember this, right? Issuer of the bond to retain the privilege of redeeming the bond at some point before the bond reached to its maturity date. So as I gave you an example, so the maturity was 10 years, but issuer they generally redeem that particular one in 7 year only. So that is called callable call option. Okay, putable, if you talk about the putable bonds, so the holder or the buyer or the investor of the putable bond has a right but not an obligation. They do not have any obligation in case of callable as well as in case of putable. They do not have any obligation to redeem that particular money before the maturity period. They do have that option. Okay, so they can buy back that particular one before the maturity, but there is as such no obligation. Please do remember this. To demand early repayment of the principal amount. So a putable bond is a type of bond that provide the holder of a bond the right but not an obligation to force the issuer to redeem that particular one before maturity as well. So this is very simple one. If you know the concept of call input, you can easily relate with this. Okay, so guys, these were some major type of bonds which we discussed in the last 20 to 25 minutes. I hope you enjoy these particular things. So bonds, again, this concept of bonds market or debt market, that is very important. Let's say if you are studying finance for GIB, CIB, or if you're studying finance for RBI grade B or any other area. Okay, so these concepts are very important for your examination purpose. So examiner, they generally give you question based on the terminology, based on the different concept or calculations. So you need to know about these basic things so you can easily understand the advanced related things as well. Okay, so I hope you enjoyed the video. If you like, please do share with your friends, do like the video, and if you are new to our channel, so please do subscribe. So this is it. I'll come with more videos, so stay tuned. Thank you.